Why would abandoning the dollar resolve all economic issues? What if numerous countries simultaneously decide to cease using the US dollar? If eliminating the dollar addresses all concerns, it suggests that the dollar itself might be the underlying problem. Now, BRICS nations and 10 ASEAN countries are considering using their own currencies instead of the US dollar. This shift will impact the US economy, as these 10 nations collectively have a GDP of $4 trillion. But what is motivating them to make this switch? Did something the US do provoke this decision? Let's find out. In a significant move that could transform the global economic environment, the Association of Southeast Asian Nations, ASEAN, is contemplating a move away from the US dollar towards using local currencies for trade. This strategy, which includes the 10 ASEAN member countries, Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, Philippines, Singapore, Thailand and Vietnam, seeks to lessen dependence on the US dollar for international transactions. The consequences of this change are considerable, given ASEAN's total GDP of around $4 trillion. Under President Joko Widodo's leadership, Indonesia is spearheading this push towards de-dollarization. By encouraging the use of local currencies, ASEAN countries aim to strengthen their economies, improve the global standing of their currencies, and reduce susceptibility to external economic pressures. This initiative by ASEAN is not just a regional maneuver, it represents a pivotal move that could indicate a shift in global economic dynamics. Let's delve deeper to understand its impact on the global economy. So, why is ASEAN contemplating a move away from the US dollar? ASEAN has long been a vital economic bloc, known for its varied and dynamic economies. Historically, the region has depended heavily on the US dollar for international transactions, a practice that has provided stability but also created significant dependencies and vulnerabilities. Recent global economic trends and geopolitical changes have led ASEAN leaders to reconsider this dependence and seek alternative strategies to enhance their economic autonomy. The move to promote local currencies for trade is driven by several key motivations. Firstly, it's about economic independence. By reducing reliance on the US dollar, ASEAN countries can gain greater control over their economic policies and lessen their exposure to external economic shocks, such as fluctuations in the US economy or shifts in US monetary policy. Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on BRICS, geopolitics, economy, and changing landscape. Let's continue now. Using local currencies can also enhance financial stability within the ASEAN region. This approach is crucial for reducing the risks tied to currency volatility and ensuring smoother trade and investment flows. Additionally, promoting the use of local currencies can increase their value and stability in global foreign exchange markets. This, in turn, can boost investor confidence and attract more foreign investment into the region. So, how can local currencies be promoted? Several mechanisms are being considered and implemented to facilitate the use of local currencies for trade within ASEAN. One such mechanism is bilateral currency swap agreements. These agreements enable countries to exchange currencies directly, bypassing the need for the US dollar as an intermediary. This can help stabilize exchange rates and provide liquidity support during financial stress. Another approach involves regional payment systems. Developing and enhancing these systems can make cross-border transactions using local currencies easier and more efficient. These systems reduce the need for currency conversions and associated costs. Trade agreements also play a crucial role. Including provisions for local currency usage in these agreements can encourage businesses to invoice and settle transactions in local currencies, gradually shifting trade dynamics away from the US dollar. Additionally, central banks in ASEAN countries are collaborating to align monetary policies and create a supportive environment for the use of local currencies. This effort involves harmonizing regulations and providing the necessary infrastructure support. What are the potential benefits of this approach? The ASEAN initiative to promote local currencies for trade is expected to bring several significant advantages. By reducing reliance on the US dollar, ASEAN nations can establish stronger economic foundations, making them more resilient to global financial instability and geopolitical disruptions. This diversification offers protection during fiscal crises or geopolitical tensions, such as trade disputes or sanctions, shielding their economies from external shocks and providing a buffer against instability. Furthermore, adopting local currencies can streamline trade within ASEAN, enhancing efficiency across borders. By eliminating the need for cumbersome currency conversions, businesses can conduct transactions more smoothly, reducing the time and costs associated with international trade. This streamlined process increases the competitiveness of ASEAN economies in the global market and encourages greater intra-regional trade, driving economic growth and prosperity. Moreover, the increased use of local currencies grants ASEAN nations greater autonomy in formulating their monetary policies. With less dependence on external monetary frameworks, like pegging currencies to the US dollar, member states have more flexibility to address domestic economic challenges. This enhanced autonomy allows policymakers to more effectively manage issues such as inflation control and exchange rate stability, promoting sustainable economic growth and strengthening the region against economic volatility. This initiative also pushes ASEAN toward deeper regional integration while enhancing economic resilience and trade efficiency. By fostering cooperation on financial and economic policies, member states develop stronger bonds and a shared vision for prosperity. This convergence of interests strengthens ASEAN, paving the way for a more cohesive and unified economic bloc, which amplifies the region's collective voice and influence on the global stage. So what's the overall economic impact? The ASEAN initiative to reduce reliance on the US dollar by promoting the use of local currencies for trade is set to have a significant economic impact on the region and beyond. With a combined GDP of approximately $4 trillion, the 10 ASEAN member countries, Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, Philippines, Singapore, Thailand, and Vietnam, constitute a powerful economic bloc. This shift towards de-dollarization aims to foster greater economic stability, enhance regional financial autonomy, and reshape global trade dynamics. One of the main reasons for this initiative is to enhance regional economic stability. By decreasing reliance on the US dollar, ASEAN countries can reduce the risks associated with fluctuations in the dollar's value, which are often influenced by factors beyond their control. Using local currencies in regional trade can provide a buffer against external economic shocks, such as sudden changes in US monetary policy or geopolitical tensions affecting the dollar's value. For example, countries heavily dependent on the dollar during periods of US economic turbulence can experience significant volatility. By promoting local currencies, ASEAN nations can shield themselves from such instability, resulting in more predictable and stable economic environments. This stability is crucial for attracting foreign investment and fostering long-term economic growth. Additionally, promoting local currencies in trade can strengthen these currencies in global foreign exchange markets. Increased demand for local currencies will naturally boost their value and stability. This, in turn, enhances investor confidence and can attract more foreign direct investment, FDI, into the region. Investors are more likely to commit capital to economies with stable and strong currencies, as these conditions reduce the risk of currency depreciation and associated losses. A practical benefit of using local currencies for trade is the reduction in transaction costs. Currently, many cross-border transactions within ASEAN involve converting local currencies to US dollars and then back to the local currency of the trading partner. This double conversion incurs additional costs, including exchange rate fees and the risk of unfavorable exchange rate movements. By directly utilizing local currencies, ASEAN nations can bypass intermediary steps, thereby lowering transaction costs. Reduced transaction costs enhance trade efficiency and profitability for businesses, which in turn encourages increased intra-regional trade. This improved efficiency can result in more competitive pricing for goods and services, benefiting both consumers and businesses. The push to promote local currencies is also anticipated to strengthen regional trade relationships within ASEAN. By making cross-border transactions easier and more affordable, ASEAN countries can boost their trade volumes. This increase in intra-regional trade can lessen dependence on external markets, fostering a more self-reliant regional economy. Increased economic integration among regional partners can result in stronger ties, fostering collaboration on various economic policies and initiatives. This integration may bolster collective bargaining power during international trade negotiations, amplifying ASEAN's influence on the global stage. Furthermore, diminishing dependence on the US dollar offers a notable advantage by mitigating risks associated with US economic policies. The prominent status of the US dollar implies that alterations in US monetary policy, such as adjustments to interest rates by the Federal Reserve, can have extensive repercussions for the global economy. Countries heavily dependent on the dollar are especially vulnerable to these shifts, which have the potential to induce capital outflows, inflationary pressures, and financial instability. Through the adoption of local currencies, ASEAN nations can shield themselves from certain negative impacts of US economic policies. This independence enables them to enact monetary and fiscal measures more tailored to their unique economic circumstances, thereby improving overall economic governance. Why is it so important for the 10 countries to move away from the dollar? The rising US debt, now at $34.4 trillion, is another factor driving ASEAN's initiative. High levels of debt raise concerns about the long-term stability of the US dollar. Developing countries, including those in ASEAN, are increasingly wary of the risks associated with holding large reserves of a currency backed by such significant debt. Reducing reliance on the dollar has become a necessary strategy. Beyond a regional tactic, ASEAN's initiative to promote local currencies has the potential to influence global economic trends. As other regions and countries observe ASEAN's progress, they might be inspired to adopt similar measures. This could gradually shift the global economic order, diminishing the US dollar's dominance and fostering a more balanced and diversified international monetary system. In the long term, this could lead to the emergence of multiple strong regional currencies, each playing a significant role in global trade and finance. Such a development would enhance global financial stability by reducing the systemic risks associated with reliance on a single dominant currency. Do you think ASEAN took the right step to solve the issues it currently faces? How do you see this approach? Let us know in the comments section. If the solution to all economic problems is de-dollarization, then was the dollar the actual problem? Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. Thanks for watching, and until the next video, stay tuned.